Welcome back to Smart Dollar Mindset, the channel dedicated to helping you achieve financial freedom through smart money habits and investing. Today, we're tackling a topic that everyone worries about but few truly understand: investing during a recession. Recessions bring fear. They bring market crashes, layoffs, declining asset values, and uncertainty about the future. But here's the truth: recessions also bring opportunity, massive opportunity, for those who know how to navigate them. In this video, we'll break down everything you need to know about investing during a recession. We'll cover the psychology of downturns, historical lessons, practical strategies, and step-by-step actions you can take to not just survive a recession, but actually come out stronger and wealthier. By the end, you'll have a complete roadmap for how to protect your money, avoid common traps, and take advantage of once-in-a-decade opportunities. Why recessions happen. Before you can invest wisely during a downturn, you need to understand why recessions happen in the first place. Recessions are periods of significant economic decline, typically 2 consecutive quarters of falling GDP. They're caused by different factors, including financial crises, like in 2008, high inflation leading to rising interest rates, global events like pandemics or wars, asset bubbles that eventually burst. Recessions are part of the economic cycle. They're painful, but they're also temporary. Historically, every downturn has been followed by recovery, and often strong growth. That's the mindset shift you need to start with. Recessions are temporary, and opportunities hide within them. Step 1. Control your emotions. The biggest danger in a recession isn't the market, it's your reaction to it. Fear makes investors sell low. Greed makes them buy too high. The best investors learn to control their emotions and stick to a plan. Example: during the 2008 financial crisis, the S&P 500 fell over 50%. Many panicked and sold everything. But those who stayed invested saw their money more than triple in the following decade. The lesson? Don't let emotions dictate your investments. Step 2. Secure your foundation. Before you invest aggressively during a recession, you need stability. That means emergency fund, have 3 to 6 months of expenses in cash. Manage debt. High interest debt makes downturns even harder. Steady income. If possible, diversify income streams. Think of it like building a fortress. You can't take advantage of opportunities if you're panicking about rent or credit card bills. Step 3. Understand the opportunity. Recessions create discounted markets. Stocks, real estate, and even businesses sell for less because fear drives prices down. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." A $10,000 investment in the S&P 500 at the bottom of 2009 is worth over $50,000 today. The point? Downturns can accelerate wealth if you invest wisely. Step 4. Invest in strong companies. Not all companies survive recessions. Many go bankrupt. But strong companies with healthy balance sheets, consistent cash flow, and essential products often thrive. Look for low debt-to-equity ratios, positive free cash flow, competitive advantages in their industry. Example: companies like Apple, Microsoft, and Procter & Gamble recovered quickly after 2008 because their businesses remained strong even in tough times. Step 5. Diversify wisely. Diversification protects you from risk. During a recession, don't put all your money in one stock, one sector, or one asset class. Consider index funds and ETFs, exposure to the whole market. Dividend stocks, reliable income even in downturns. Bonds or treasuries, stability and lower volatility. Real estate can provide cash flow if managed well. A balanced portfolio gives you growth potential without betting everything on one outcome. Step 6. Keep investing consistently. Timing the market is almost impossible. That's why dollar cost averaging, investing a fixed amount consistently, is so powerful. When markets fall, your money buys more shares. When markets rise, your shares grow in value. Over time, this smooths out volatility and builds wealth. Example: if you invested $500 every month during the 2008 recession, by 2020 you'd have a portfolio worth far more than if you had waited on the sidelines. Consistency beats timing. Step 7. Avoid speculation and hype. Recessions tempt people to gamble. They chase get-rich-quick stocks, penny stocks, or risky ventures hoping for fast gains. Most end up losing everything. Stick to fundamentals. Remember, wealth is built slowly, not overnight. Step 8. Consider real estate strategies. Recessions often push housing prices down, making real estate more affordable. But be careful, cash flow is key. Look for rental properties that can cover expenses even in tough times. Avoid over-leveraging with debt. History shows that those who bought real estate in downturns, when prices were low, built significant long-term wealth. Step 9. Build long-term perspective. Every recession in history has eventually ended. The US economy has always recovered, and markets have always reached new highs. Example, the Great Depression was devastating, but those who held strong investments eventually saw massive returns. Investing during a recession isn't about the next 6 months. It's about the next 10, 20, or 30 years. Step 10. Stay educated and adapt. Recessions teach valuable lessons. Stay informed. Read financial news, study market history, and learn from successful investors. Adapt when needed, but don't abandon your long-term plan. Recession is an opportunity in the face of uncertainty. Choices define the future. Consider the panic of the first individual, frantically liquidating assets, tethering their hopes to a false sense of security. Meanwhile, the second person, unfazed by the chaos around them, methodically nurtures their investments, aware that opportunities unfold in turbulent times. What path will you choose to navigate life's unpredictable journey? Imagine reflecting on your decisions, feeling the weight of missed opportunities pressing down. Would you rather be the one who allowed fear to dictate actions or the one who embraced challenges, paving a way toward prosperity? Choices matter in every economic storm. In the end, the true measure of success lies not in the absence of hardship but in the resilience to face it, emerging stronger and wiser. Choose to be the architect of your fate, and let your decisions today sculpt a brighter tomorrow. Final thoughts. Recessions force us to rethink our strategies and reassess our goals. It's in these trying times that the strongest emerge, ready to seize the hidden prospects others overlook. Instead of panicking, focus on your financial education and agility, adapting your approach as necessary. Embrace the lessons that come with economic challenges, for they can sculpt your path to success. Whether it's exploring new investment avenues or honing your skills, every obstacle is an invitation to grow. Shift your mindset from fear of loss to the excitement of potential gains that only arise in times of hardship. Your journey may just be starting, and the best is yet to come. In this landscape of uncertainty, strategic risk-taking can pave the way for breakthroughs. Identifying undervalued assets and opportunities will define your resilience. Remember that each challenge in a recession is a chance to reflect on your priorities, and that diligent efforts can yield substantial rewards. When embraced with the right mindset, recessions can be transformative experiences. By navigating through challenges with discipline and focus, you build not just wealth, but resilience. In the end, it's not just about weathering the storm, it's about emerging stronger and more prepared for the future ahead. If this video gave you clarity and confidence, subscribe to Smart. Our mission is to help you achieve financial freedom through smart money habits and investing. Join our community, turn on notifications, and take the next step toward your financial future.